Hi Accounting 1. In this video, I'm going to go over how to do more adjusting entries. This problem is right from your book, exercise 3-19A. Okay. So what it's asking is to explain how accrual accounting differs from cash basis accounting. Accrual accounting, you're going to recognize the transactions as they occur. Cash accounting, you only recognize when it affects cash. So you will see there'll be some discrepancies with net income between cash and accrual accounting. All right, so let's go through the different transactions. Here's the first one. Prepaid insurance had a beginning balance of $500. All right, so let me kind of go over here and then I'll erase. All right, so what I like to do is I do a T account first. All right, let's do prepaid insurance. Okay, first off, you need to know accounts. Prepaid insurance is classified as an asset. So in order to assets to increase, you debit; to decrease, you credit. When you're first learning, it's helpful to do a T account and put debit and credit. Okay? It's an asset, so a debit will increase, a credit will decrease. Okay, so let's look at it. Prepaid insurance had a beginning balance of $500. We'd put that on the debit side. And then it says payments for insurance during the period were $2,000. Okay. If they bought more prepaid insurance, what would they have done? They would have debited prepaid insurance and credited cash. So if they paid for more insurance during the period, and you're trying to figure that out, that would be on the debit side, $2,000. Then it says the ending prepaid insurance balance was $400. Draw a line. That's your final balance, $400. Well, you have to figure out how much you've used. So how would you do that? You're going to take $500 plus $2,000 and you'll subtract out the $400. And when you do, so $2,500 minus $400 gives you $2,100. So you're going to make the journal entry for $2,100. I'm going to erase now, and now we'll do the journal entry. But the first thing is you had to figure out how much you used. All right, so now we do the journal entry. We're going to debit insurance expense. $2,100. And we're going to credit prepaid insurance. $2,100. Okay, you just completed your first journal entry. Here's the second one, B. Interest revenue accrued $2,500. Okay, they didn't make you figure out the interest. Later on, I'll show you how to do that. They just said interest accrued, so you're going to make the accrual for interest. Interest revenue. Now that's different than interest expense. Interest revenue is a good thing. That means you're going to receive interest. So what do? You debit interest receivable. And that's $2,500. And you credit interest revenue. $2,500. Okay? This particular problem is not asking us to give descriptions of journal entries. Some of them will, and so you'll have to choose that for the drop-down window. Here's the next one. C. Unearned service revenue beginning $1,700, unearned service revenue ending $300. I would do a T account. All right, so let's draw a T. Unearned revenue. You have to understand account types. what is unearned revenue within the 5 main elements. Remember, 5 main elements: asset, liability, equity, revenue, expense. Unearned revenue is classified as a liability. So you're going to know how to increase it, right? You know, anytime you increase a liability, you do what? Exactly, you credit. All right, so let's draw. We got a debit here. A debit will subtract. Unearned revenue is a liability. A credit will increase. It's helpful when you're first learning accounting to do that. So unearned revenue, it just said beginning. Well, that's the normal balance. It's a credit. Then it says unearned revenue ending. Draw a big B. That's what's still left. Okay, so in order to decrease unearned revenue, you're going to debit. Well, it was $1,700. It's now $300. Okay, so how much will you decrease that account? $1,400. All right, if you had unearned revenue initially, that means they've earned some of the revenue. How much have they earned? $1,400. Let me erase that now. You have to do that when you do adjusting entries. Adjusting entries are difficult because a lot of times you have to figure out the amounts. All right, so now we're going to go over and we're going to debit unearned revenue. When we're doing that, we're decreasing our liability. Unearned service revenue. Same thing, it's a liability. $1,400. And then we're going to credit service revenue. $1,400. Okay? All right, that is C. Then I go to D. It says depreciation on building. That's it. You just have to know what the journal entry is. You're going to debit depreciation expense, credit accumulated depreciation. Accumulated depreciation is a contra asset account. That's why you're increasing that with a credit. It's the opposite of a normal asset. So I go over to the board and I'm going to write depreciation expense, label it, that's a building. It told me the amount, it did make me figure it out, and that was $5,600, my debit. My credit is accumulated depreciation, can't spell, building, I'm running out of room, 5,600. Okay? All right, next one. Here's what it says. Employees' salaries owed for 2 days of a 5-day work week. The weekly payroll is $19,000. All right, why could that happen? Well, think about it. Most of you out there, when you work, you most often paid on Fridays. Or sometimes you could be paid on a Wednesday. But anyways, we're going to think of Friday. So those employees, the cutoff period, say it was the end of December, December 31st, they're closing their books. Well, they close on Tuesday, but the people for that particular business are not paid until Friday. So they're going to make an accrual in that case for 2 days, for Monday and Tuesday. So their weekly payroll is $19,000. Okay, so let me go to the board. The weekly payroll is $19,000. They're owed 2 days. You're trying to figure out the amount. Use a fraction. 2 is your numerator. 5 is your denominator. Multiply it out. 19,000 times 2/5. That gives you $7,600 that you're going to make this accrual for salaries. $7,600. Okay, now I'm going to erase. And it'll be all different ways. If it was 3 days, you would do 19,000 times 3/5. If it was 4 days, 19,000 times 4/5. So make sure you understand how you're coming up with that fraction. All right, so now we debit salaries expense. We're increasing our expense 7,600. And then we credit salaries payable, also increasing our liability. We haven't paid it yet. We're completing an accrual, 7,600. All right, then F, here's what it says. Income before income tax was 21,000. Income tax rate is 35%. So you're just going to take 21,000 times 0.35, and then we're going to make the adjusting entry. We're going to debit income tax expense, $7,350, and then we're going to credit income tax payable, $7,350. Okay? All right. This particular problem makes you do the journal entries first. Here's what it says on the second part. Suppose the adjustments were not made. Calculate the overall overstatement or understatement of net income resulting from omission of these adjustments. Okay, it's only asking for net income. You know, in order to get net income, you will subtract revenue minus expenses. So we're only looking at revenue accounts and we're only looking at expense accounts. All right, so if we didn't do this, net income will be understated. Understated, I'm only going to find my revenue accounts. All right, so let me look. Where's my first? Is that a revenue? No, that's an expense account. Where's my first revenue account? Interest receivable, what's that? That's an asset. Here it is, interest revenue. That's my first revenue account. So I go over here and I put in interest revenue. And I write it, it's 2,500. Okay, I'm looking only for revenue accounts right now. Oh, unearned service revenue. No, that is not a revenue account. However, service revenue is. So I go over here and I put service revenue. And that is 1,400. All right, let me look and see if I have any more revenue accounts. Nope, I do not. So now I'm going to total these. And my total understatement, okay, if I didn't make these adjustments, my total understatement would be 3,900. And that we're going to show in parentheses. That's my understatement. Okay, net income overstated. If I didn't book these expenses, my net income would be overstated. It would be too high. You're comparing cash to accrual. Accrual, you're going to make this adjustment even though you haven't paid cash yet, or even though you haven't received cash. You're still making these adjustments. I will tell you, all the public companies use accrual accounting. A small business most often would probably only recognize it when they receive cash, so they're going to do cash accounting. All right, so now we go net income that is overstated. How? Well, I'm looking for my expenses. Here's my first expense, insurance expense. Prepaid insurance, no, that's an asset. However, insurance expense is an expense. So I put over here, insurance expense. What's the amount? 2,100. I go to my next entry. Nope, that's not touching any expenses. Is this touching an expense? Nope. Yes, this is touching an expense. So depreciation, expense, 5,600. Okay. Go to the next one. Is this touching an expense? Yes, it is. The salaries expense is. The salaries payable is a liability. Salaries expense. How much? 7,600. Go to this entry. Is this touching expense? Yes, it is. Income tax expense. Income tax payable is a liability, but the income tax expense is. Income tax expense, and that is 7,350. I total those 2,100 plus 5,600 plus 7,600 plus 7,350. This one has you do a sub. Okay, so the total of this is 22,650. I ran out of room, everybody. I apologize. All right, so 3,900. And then it says, what's the overall effect? Overall effect. I'm going to do this in a different color marker so you can really see it. The overall effect. I'm going to take the 3,900 and I am going to subtract the 22,650. Well, this is a positive. This is a negative. So my positive is more. It's 18,750 positive. That's a positive number. So my overall effect is 18,750. And that's how you do that problem. It's a long one. Make sure you're understanding. So if we didn't do these adjustments, we didn't do all these adjustments, our revenue would be understated by 3,900. Show that in parentheses. If we didn't do these adjustments, our expenses or our net income would be overstated by 22,650. What's the overall effect of the 3,900 and the 22,650? You're going to have a positive 18,750. Okay? And that's how you do that particular problem. I'll see you soon.